Hey everybody, Chuck Barone, Monday, December the 5th, 2022, on with a new week of crazy in finance and money, man. I tell you what, it's every day is an adventure. I wish it could be boring like it's supposed to be, guys, honest, but apparently it's not to be. As always, we want to welcome you to the show. Thank you for all of your support, watching the videos, all of your likes, questions, comments, everything you guys do for the show every day to keep us going here. We appreciate you guys. In the markets today, well, stock market today, kaboom. Basically give back now all of the gains from the big rally last week. Not all of them, just most, right? Like I was saying last week when the market rallied that it was a mirage. The market is so data-driven right now, and it's just going to be like a seesaw or a teeter-totter with the way the data comes out. So last week, the market just got all crazy happy about the way they interpreted Powell's comments, which I interpreted to be much more hawkish than they did. And the market really went bananas. And I was saying it's not going to last because the first whiff of bad news, or the first whiff of something contrary to what they wanted to believe, the market would correct, and here we go, already today. So, stocks down, bond market also retreating after a gigantic rally last week. Prices down with yields up. The 10-year up 10 basis points, sitting at 3.60% today. The 2-year up 12 basis points, sitting at 4.40 today. So now we got an 80 basis point inversion here. They say that the deeper the inversion, the deeper the recession to follow. So the bond market's sending us a pretty clear idea as this inversion gets deeper and deeper of what we got to look forward to into 2023. The dollar today, with now the consensus being rates are going to be higher for longer, just exactly as Powell said last week. Dollar rally is almost a point today, 105.35 on the index. The dollar's still the champ, guys. And I mean, obviously 105 is down quite a bit from its high, but it's still, I mean, the other world currencies just are lagging right now. With the dollar up like that, metals, another give back day, sadly. Gold down almost $29 today, sitting at $1,769. Silver down 88 cents, $22.32. I think this was a reluctant sell-off today. I think metals really want to move up. So if you're holding metals and you're concerned about this decline today, don't be. I think that metals want to rally and will. Just the way it works with the dollar, I think we all know the dollar won't stay at over 105 forever. As the dollar comes back down to normal, metals will rally. Oil also down pretty good today, down 3.3%, $77.39 for a barrel of West Texas Intermediate. Surprising. Gas also, natural gas down pretty good, 10.5%, another wild ride down the hill, $5.62 for their million BTUs. It's those markets have just been wildly swinging all over the place. Be very cautious if you're involved in those markets. Bitcoin today down small, $128, $16,964 last I saw. Hanging in there, Bitcoin is. Be cautious with this as well, guys. This whole part, all these cryptos, Bitcoin and all the rest of them, is kind of subject now to events beyond their own control with the collapse of FTX, a couple other big exchanges and participants in this market going under or filing for bankruptcy or restricting. Be cautious with this stuff, guys. This week, we know as on Monday, I always kind of give you guys an idea of what to expect this week, what we can expect as far as data coming in that can affect these markets. Well, today we got factory orders, which we'll go over toward the end here. We're going to have earnings all week. Tomorrow we'll get trade deficit information. Wednesday gets to be a little bit busier. Wednesday we will get consumer credit reports. Look at the mortgage bankers index, which I'm sure will be pretty ugly. Look at productivity reports. And I've been reading that productivity has been down pretty good. We'll see that unit labor costs, that's going to be a big one on Wednesday. That's going to give us a little bit more idea of the Fed's direction. With, they're really concerned about the wage price spiral, as they should be. I've explained it many times in this show how that works. These are all going to give us ideas about what's happening, and what we'll try to get an idea of how the Fed will interpret these reports and how normal bankers would react, right? On Thursday, we'll get initial jobless claims. That's a big one. And on Friday, we'll finish the week with the University of Michigan Consumer Index. We'll get PPI numbers, which will be really interesting. We'll get wholesale inventories. This will tell us, the PPI is the one I'll be looking at, because producer prices give you a little bit better idea of what you're going to be dealing with consumer prices going forward. Producers typically don't eat those costs themselves, or those rises in costs. Usually that gets passed along and it reflects on CPI, even plus they have to add their profit on. You know what I'm talking about. So a lot of interesting data coming this week. Give us a really good idea of how this year is going to finish, what we can expect as far as the Federal Reserve interest rates, and how the markets are going to react to those rates next year. 2023 is shaping up to be a fascinating year, because you're going to see the real decline soon of housing prices. I cannot wait to see what the interest rate number the Fed is going to have to raise to get this inflation back down to 2%, because once that genie's out of the bottle, man, it is really tough to get it back in there. Takes a lot of time, and I don't know if Americans are patient enough now to deal with the length of time it's going to take, to deal with the pain it's going to inflict on their own personal lives and the cost of money, as well as the economy. Fascinating stuff coming up. The Federal Reserve actually have the guts to follow through on their mandate and to get inflation down? The stability of prices is their number one mandate. It's the main thing their job is. Now, they always talk about full employment, but right now those jobs are in conflict. So which one takes priority? Well, the Fed has already kind of indicated that they want employment to kind of cool off a little bit. We'll see how that continues to play out and moving into 2023 as well. Now, some news you guys need to hear today. U.S. services, industrial services pick up in November. The November manufacturing PMI increased to 56.5 from 54.4 in October. Services across the U.S. picking up. Businesses, as much as we want to believe there's a terrible recession out there, and there probably is for some people, it's not being felt in services right now. Services, restaurants, that kind of stuff, entertainment. 56.5 from 54. It's an 11-month high. And anything over 50, of course, shows that business or the industry is expanding. So our service industries are expanding. And the forecast had called for it not to rise to 56.5, but to fall to 53.3. So surprise markets, the economy is stronger. Surprise economists, I guess. The economy is stronger than you thought. And this really kind of does not play well with this Fed idea. We know, and I've explained many, many times, that it's not the rate increases that are going to bring inflation down. It's the recession those rate increases are going to cause that brings down inflation. When you see hot numbers like this tells us pretty certainty that we have a long way to go in this inflation fight because the economy just wants to keep moving forward, apparently. So now, we know that services, but how about manufacturing? Because that's a big part of this. Well, manufacturing contracted. First time in 2.5 years. Not exponentially, nothing terrible, but it came down. But more than made up for with services. And today also we came out with factory orders. Now check this out. Factory orders up 1% in October, up from 0.3% in September. Factory orders up 12.8% year over year. So guess what? Conflicting data, but it doesn't sound like manufacturers are struggling or in dire straits by any means when your factory orders are up 12.8%. So there we have it, guys. A mixed bag of who the heck knows. It seems like one day we're happy, the next day we're sad. Well, the good news is this. The basic fundamentals we've been teaching you guys from day one. Save your money. Try to save a set percentage if you can. The target being 10%. If you're saving 10% of your income and you're living on 90%, that's the very first step. Well, not an easy one, but the first step on really making yourself wealthy. Because not only will your savings go up every time you get paid or get income, but you learn to live on less than you make. Most people don't do that in our society anymore. Matter of fact, most people live on more than they make. So this is the first step. If you're following this basic step, if you're investing defensively like we've been advocating, if you're spending your money more thoughtfully, if you're not adding on any new debt, and if possible, chipping away at your existing debt, well, guess what? All of this crazy doesn't really make much to you. Now, sure, it sucks paying more at the gas pump, sucks paying more for basically everything, especially in the supermarket. But you're dealing with it and you're still in surplus. That's where we want to be, guys. We want to be in surplus. We want to add to our stash as often as we possibly can. And we want to hold that stash tight. We don't want to invest super aggressively. Not right now. Now is a time to be defensive, a time to preserve. There'll be other times when times are booming and better and every cycle changes. Every cycle comes to an end. This one will too. And when times are better, then we look to get aggressive and grow the money. But right now, the focus is on preserve what we have. Anyway, that's it, guys. A big week coming up. We really appreciate your support. We'll be back here all week at the close of the markets to bring you guys up to date on the news you need. Stick to your guns, guys. We're on the right path here. We'll be back again tomorrow. As always, if you like what you're hearing, hit that like button. Check your subscriptions and your notifications. As always, ask your questions. Make your comments in the comments section. If it's something a little more complex, a little more wordy, or a little harder to explain, a question you have, ask Chuck Barone at gmail.com. That's it for today, guys. We appreciate you. We'll be back again tomorrow. Till then, take care.